welcome to the Absa Bonus Edition webinar. This is where we will be having conversations about the opportunities that you have going forward during this season as you receive your bonuses. Where do you put that money? My name is Jimmy Mbogo. I'm a digital banker and business journalist here in Kenya. And for today's session, I have the privilege of steering this conversation. Now, in case you're wondering what this Absa bonus webinar is all about, and just allow me to take you through this. And this is a series of conversations aimed at helping you, our customers particularly, to make better decisions, particularly on where you spend your money. This, you might be asking yourself, why is this important? And I will tell you, one of the things that this will help you with is to make sure that any one of you who's receiving a bonus during this windfall season has options in terms of where does that money go, what are some of the opportunities out there that you can tap into. We'll also help you in terms of just prioritizing how you spend these bonuses, from as little as 10,000, 5,000 to as high as your bonuses are. We will have a solution and an option for each one of you, and we want to take that headache away of just looking for what are the viable opportunities out there in the market. And to help me with that conversation, I have a panel of experts from right here at Absa Bank who will be helping us with that conversation and painting a picture for us in terms of what the macros look like, whether globally, locally, and also what are some of these options that you might be having. And help me at this point now, allow me at this point to welcome my panelists who are here with me. And I want to start from my immediate right. This is Elizabeth Irungu. She is the head of Absa Bank Asset Management. Elizabeth, good morning.
Good morning and welcome our customers
to
today's webinar.
Yes, we also have Mr. Mwenda Rarama. He's the Chief Investment Officer, Absa Bank Asset Management. Mwenda, good morning.
Good morning.
Are you ready for our chat?
Oh, yes, we are.
All right, wonderful. And we also have Mr. Eric Idali, who is a Wealth and Investment Manager right here at Absa Bank. Eric, how are you feeling this morning?
Great, excited, ready to have this wonderful conversation.
All right, and I think, wonderful. And I think we'll get straight into this conversation. And I want to start with Elizabeth, who's right here on my immediate right. And Liz, one of the things that we really want you to help us understand, there's so much happening, whether globally, locally, but I want you to help us set the stage in terms of what is happening globally, what are the opportunities out there, and what is the ripple effect of what is happening globally that is likely to affect us here in Kenya.
All right, thank you very much. I start off by first of all acknowledging each one of you for joining us this morning, and to say that we are living in a world which is going through a term that was coined some time back, VUCA, volatile, ambiguous, complex, and it's just complex, and you may not understand it. I think there's a lot that's going on, so I want to take you through what we are seeing in the global markets, which of course we cannot ignore. Everything trickles down to what is happening around the world, and it shapes what we do as investors. So as I slide to the global markets, sort of slide. Okay, here we are. Looking at that world map there, we are seeing the geopolitical risks have just evolved to even higher levels. We are saying we are at a crescendo on geopolitical risk. I think that materialized immediately. We saw, the US and Israel launch extensive strikes against Iran. And while we were hoping that this was going to be short-lived, unfortunately now we are on the third week of this war, and this has changed the perspective around the world. We cannot forget that in January we had the Venezuela situation. It's still evolving, it's still going around, and as you can see from the map there, the geopolitical tensions across the world are so many. Those are the orange dots that you're seeing there. We are seeing a world that is actually disrupted quite a bit, and therefore decision making, whether you're an investor, whether you are a business person, or even just in your personal capacity, becomes quite a complex matter. And we are saying, for the investor, what do you do when this kind of situation snowballs right in front of you? Some of it expected, some of it really out of the ordinary, and the repercussions touch many different sectors of the economies across the world. Who suffers the most? Where the opportunities are when such things happens? Something that you'll notice is that the economic growth projections are still strong. Globally, the economy will still be expected to grow at 3.1%. We find that the developing economies, which Kenya would fall in that category, is still expected to lead in terms of the performance. And so overall, we are saying that the GDP performances are not going to significantly come off, but definitely structurally, we would see a world that is much more different than what we have enjoyed in the last many years. So what happens? And my question is, what happens when the disruption is touching one of the major resources that is used in most world? 20% of global oil supply has been affected by the war that we are seeing, the current war, the Iran war. That is going to mean that economies have to shift. The way we operate and the way we work with different other, international players has to shift. So trade is one of the things that gets to be affected directly. So we see the over-reliance on the Middle East getting impacted, and we think that that over-reliance there has to be diversification story. So we believe that economies are going to take it more seriously when it comes to using alternative sources of energy, of course, and that's long term. But in the meantime, we will definitely have the impact of the high prices of energy coming in and trickling into the economy and into the goods and services that we consume in the different economies of the world. Already that is happening. I think Kenya was shielded when we saw the oil prices announcement last week. They did not change, but that doesn't mean that is a permanent situation. It's going to change, and we will see ourselves definitely being affected because supply chains have been affected, and that means even other goods will see a bit of change, and also matters to do with insurance becoming more expensive, the timelines for shipping becoming longer, so you get the impact trickling down to your household, even if the war is taking place miles and miles away from us. But what is important to investors is, how do we behave? How are people behaving in times like these ones? So there are two ways to look at it. There are those who will react on the short term, and then there are those long-term investor behaviors that will emerge. So if you look at the short term, and we've already passed that phase, which is usually days and maybe a week after a crisis has come up, you find that emotions will run high. And the emotions of investors are demonstrated by how markets will perform. So you find panic, there is fear. So immediately the war happened, you would recall that oil prices hit all the way $109 to a barrel. And that tells you there was panic. But after that, the oil has steadily been trading range bound, which tells you that the fear, the panic is actually coming to an end. But that doesn't mean the trajectory has changed. The trajectory is actually positive, but the panic has actually started abating, and investors are reacting with more, clarity. And that's what we like, that there will be clarity once people find the bearing and the new equilibrium of what is happening. In terms of strategy, which is the second thing, we see that in the short term, most people exit in a hurry to try and preserve their capital. And it's not abnormal. However, that's natural. When you're investing, you have to recognize that investors are behavior. They're very emotional. So the emotional part of it will always come in. The first instinct is to make sure that you exit anything that looks really precarious at a point of crisis, and you try to preserve your capital as much as possible. Then the third thing that happens is the asset preferences. How do people, what assets do people then prefer? I think I even forgot one. Safe assets, we could have put there gold. People run to gold, silver, and cash. So everybody's saying, now I need more cash, I need more gold, I need more silver. So if you look even in the tables internationally, you find that gold, silver, they have actually been trending upwards because more investors are actually allocating, or the new monies that need to be redeployed, they're first of all landing in the safe assets before being redeployed. It is a normal thing because you need to unravel the outcomes and the long-term impact of the crisis that you are going in. And you'll recall even during the COVID period, that same thing happened. The markets actually crashed. This time round, I think we did not see the markets crash, but we saw the markets go down. Behavior-wise, we are reactive. That in the short term. Everybody is reacting. Let me tell you an example. I think when it happened and the war in Iran snowballed, and it was very clear that Iran was going to was reiterating by fighting with the neighbors. Most people wanted to exit the Middle East, and we saw some people paying tickets out of Dubai up to $350,000. That's a crazy, astronomical number. You would never buy a ticket at that price, but because you're reactive, you're thinking death is near me, I need to really get out of this place, such kind of prices actually become real, and they are now in the records that indeed you can pay a price of $350,000 to get out of an area that is ordinarily one of the cheapest exit routes when it comes to travel, air travel. So that's reactive. Have you also reacted? Ask yourself that question. And then the time horizon, it's usually immediate, it's more about survival and all the things that investors will do. And even when you watch the screens, the Bloomberg and all that, you'll find people are reacting more for the immediate survival, because we still do not know to what extent things will go. But what is important to note is that while all this is important and we are not undermining the survival, the need for survival during a crisis, you need to look at things in the long term. We need to anchor on what will happen or how things will pan out into the future, maybe the new normal that will happen. So emotionally, you need to be as we enter the long-term season, we need to still to start being more, to have cautious optimism, and that means you're not ignoring the fact that there's a crisis, but there's optimism towards how you are managing your money and how you are making decisions, whether they're business decisions or personal decisions towards your investments. Then in terms of strategy, people will start re-entering and growing. We have seen people who are looking at opportunities that are arising. Case in point, you find that let's say, for example, we're finding if you are offering alternative, energy sources, I think that becomes a big opportunity, because people will start re-entering and looking for growth areas that are out of the crisis situation. Asset preferences in the long term, it's more about diversification, because crises will come, and they will come, and they're coming more frequently than we have ever experienced. So we are living in a very different time. And when I said VUCA times, it really is VUCA times. And so even your portfolios need to reflect the fact that crises are coming much faster, much shorter. And so your time to respond and to anchor your portfolios are much, limited. And for that reason, you need a diversified portfolio. So this being, I think, since 2020, maybe our fourth crisis that we are going in as a global world, diversification now need to have sunk into most people. And I believe that this webinar will help you to even think harder about your portfolios being better diversified. And diversification happens at geographical levels, at your asset allocation levels, at also at the asset allocation levels. So the assets that you pick, and of course the geographies that you are in. The behavior should be more strategic. If you stop being really reactive, you should be more strategic, not what we call actually, let me just use the word reactive. So your portfolio should not be a knee-jerk reaction where you see that maybe, the stock market, when the Iran war came, I think went down in Kenya at 2%. You shouldn't be part of the people who are panicking and selling off everything. You could maybe be strategic and say, what are the sectors that are going to suffer the most? What are the sectors that are going to benefit the most? And you strategically allocate your resources accordingly. And that way you build. Now look at the bubbles that are on the right there. Global markets performance. We have seen more resilience than volatility. So we believe that the markets, because of going through several cycles of crisis in the world, we are seeing more resilience than a reactive behavior among investors, and not only in our emerging markets, which are leading there, which is quite good. Even in the developed market, the US, which is the biggest market and tends to be quite reactive. We have seen the S&P 500 only decline by -2%, which is quite interesting because if you compare with what happened in during the COVID crisis, we saw the S&P 500 actually go down quite significantly and impact people, rapidly. But the recovery was also as fast. In this time round, we are seeing all the markets have been quite resilient, and we expect that that is likely to be sustained. However, be careful because the volatilities will continue being there because we are getting new information as the crisis evolves and as the world gets the new bearing of how will things pan out. But key drivers that we are watching out, economic growth is still expected to be strong. Another driver for the resilience, we believe, is the strong corporate earnings that we are seeing not only in Kenya but across the world. We've seen the earnings reports which have been released being quite strong and really supporting the valuations that are currently in the market, and then investors are more optimistic, more indicating that they have taken a more strategic view about markets rather than being panicky. Thank you very much. Back to you.
All right, thank you very much, Elizabeth, for painting that picture. And I think that's where I want to bring in Mwenda into this conversation. Now, Mwenda, what we are sure now is that, and as Liz rightfully says, crises are coming in more frequently, that volatility is becoming something that businesses and economies have to deal with on a regular. Now, when you bring this conversation to the local level, to the Kenyan setup, how is 2026 looking? Because the impact of what is happening in with Iran, Israel-US war is likely going to be felt right here in Kenya and in the region.
Thank you. And in a world that is extremely unstable, then as a country, one of the things that you need to do is figure out how do you insulate your people against some of these issues. One of the things that we saw with COVID is there was a lot of reaction at the very beginning, dealing with it as if it was a financial problem, yet it was a health problem. For the countries that actually dealt with a health issue as if it was a financial problem, created a lot of money, there was a supply problem, we ended up with inflation, quite a bit of it. That insulation is something that each and every economy must work towards. So Kenya, over the last Saturday, we did discuss this in our last webinar as well. Kenya has gone through, as of course, a lot of structural issues, but the issue is, are we fixing them as we progress? So from a GDP point of view, do we have diversity? Yes, we do have diversity. There has been quite a bit of diversity economically because agriculture used to be our bread and butter. It's not that it has shrunk, but we have seen the other contributors to GDP grow quite a bit in terms of significance. The other question is, how are we managing both internal inflation and as well as imported inflation? So I'll kick off with the internal inflation. One of the biggest drivers has always been the cost of food. I think that with the rains has abated. We have seen inflation come down. We do not expect, we did yes have a drought, but the rains are here now. We do not expect to have a pressure in terms of food prices. So let me just shift gears to imported inflation. So it comes to imported inflation, there are two things that lead to it. One is, of course, the currency. So any weakness on the currency, anything that you import in becomes more expensive and, of course, has an impact. So one of the things that we have seen is the fact that oil prices are up, and Elizabeth did speak to that. With a more unstable economy, we'll definitely have a lot of volatility in prices as well. So that volatility, how do you insulate against it having a double impact? Because if you have a weaker currency and you have a higher price on the commodity that you're importing, then you do actually have a double shot kind of scenario where you end up having an incremental price because of the currency alone. So you have seen stability on the currency, and that stability is what we are seeing on our left. Starting from March of 2024, we basically have seen a lot of stability on that currency. What has that done? It has actually enabled CBK to raise quite a bit in terms of reserves. As a business owner, as someone making decisions, you know when you need the currency, it will be available. So you don't need to stock up, you don't need to build up any dollars because you know the price is not changing, it's predictable to a large extent. It makes it a lot easier for you to make business decisions. When you need the currency, you will find it. If you need to sell it, then you know the price that it's going at. So it takes away the uncertainty that are currency that has a lot of movement. But the question is then, given that we still have structural issues, we still have a lot of fiscal challenges that we're still facing as a country, then are you able to still, in the short term, be able to defend that currency? The defense of that currency is based on the reserves. We now have a 6.2 months reserve, that is the graph on your right. That tells you that we have had a significant jump over time. This is the highest you have seen in quite a bit of time. The last times we were at almost 6 months of import cover was way before COVID, the period of March of 2018. But in 2021 as well, we did have a period where the government did build quite a bit in terms of reserves, most of it coming from the fact that they have issued Eurobonds. We did see a Eurobond issued as well. That has boosted the reserves. That enables you to be able to still have the currency available for any imports you have without having an impact of your currency, without having to come and build a lot of demand as such, that demand can be met by the reserves that are available in the country. That, of course, has a major impact on imported inflation. Now, the other thing that impacts what we see is capital flight. Over the last couple of years, and this goes all the way to 2019, what you are seeing is that we have seen quite a bit of foreigners exit the stock market. A lot of what we now have is participation by locals significantly. Before COVID came, we did have a significant portion being foreign owned. Foreigners were very excited with the emerging market stories. Things were doing well. There was a lot more stability. You remember the days of the IPOs and post-IPOs. And of course, foreigners stayed, and they built quite a bit in terms of portfolio. And to some extent, in some institutions, they built up as high as almost 40% of ownership in some of the listed institutions. That tells you that interest was there. But what have we seen since the COVID period? A lot of it has been capital flight. That hit us quite a bit during COVID, post-COVID, because a lot of that, of course, means demand for dollars is there, because foreigners will only exit when they do sell this. There's demand for the currency, and that currency is basically being shipped out of the country. So that creates a double-edged sword. You have a stock market that is being hit by a lot of exits, but you also have a currency that is getting demand, because the person who is exiting the stock market or any other investment locally is also looking to get currency so they can move out of the country. So what we have seen, and that's why you're seeing a lot of red negative, this is basically net flows. All through from 2020 to now, we have seen quite a bit of significant exit by foreigners. Then one of the things that has also happened in the last 2 years, we have seen retailers coming back into the market. The average Kenyan is back into the market, is actually a participant in the stock market, because the last 2 years have delivered very good performance. 2024, 2025, very good performance. And if you look at our equity fund, last year, we did deliver 40% return. That tells you that we have strength. It's not because the institutions have actually, because Elizabeth spoke about the economic side of it and also the corporate earnings. What we have seen is increasingly our corporates have become stronger, have become more strategic in what they do, in the kind of business they do, whether it's banking, whether you look at Safaricom, whether you look at EABL, the kind of business that they are doing and how they are doing it has created a lot of stability as well. And their growth has been phenomenal over the last couple of years. But that was not showing in the stock market because the activity has been very low. We did not have price discovery. So over the last 2 years, because of the interest that we have had, then we have had a lot of price discovery, and some of those very strong fundamentals that we all see, banks have been releasing results. You have seen some of those results, phenomenal in terms of performance. That needs to show in the price. With a depressed market, you don't see it in the price. But in a market that is actually active, then we do have proper transmission of those fundamentals. So fundamentally, economically, the country has continued to grow from an economic point of view. The corporate earnings have still continued to grow to a large extent. We have a lot less in terms of foreign participation in our market, which provides a lot of insulation to the currency and to anything that has to do with imported inflation. Yes, we know the oil prices have not been adjusted, but we all have the cognizance of the fact that oil prices have gone up. How the government reacts to it, where they have capacity, I do believe they have built capacity enough to be able to weather some of these storms. But that doesn't take away the fact that we still have structural fiscal issues that we need to deal with. Jimmy, thank you.
All right, thank you very much, Mwenda. Now, I want to bring Eric into this conversation. Now, Eric, where you sit is at the investment desk. You are right at that position where you're engaging with a lot of our customers in terms of just looking at where should I put my money, and talking them and taking them through that. And I want you to help us understand, based on what you've had from Elizabeth, based on what you've had from Mwenda, in terms of the risk and in terms of the volatility that is currently going on globally and also locally. There are also opportunities for investment. And I want you to help us now understand, as I look forward in diversifying my portfolio, what are some of the key things that I need to start thinking?
Okay, so Mwenda and Liz have painted a very nice picture about what has happened globally as well as locally. And the thing with the investment vehicles is that different investment vehicles will work differently in different scenarios, right? So you'll find certain asset classes in terms of volatility perform well, certain asset classes in terms of volatility don't perform that well. And the thing an investor needs to look at is that, one, what is my risk profile? Because investment options are far and wide. So risk profile is one very key thing. Secondly is, what is my objective? So you'll find many a times people invest in solutions which don't match the objective, right? So there's always that mismatch between what the product is supposed to do vis-a-vis what my objective was. The other thing to look at is also the liquidity. How quickly can I get in and out of this investment vehicle? Last but not least is my time horizon, right? So in the investment world, you'll find solutions are categorized in certain classes, right? And each class has its own pros and cons. To start off, in terms of volatility, whenever there's a bit of uncertainty, most people tend to park money in cash or near cash solution, as Liz articulated. And that's where now the money markets come in. Money markets are one of the most popular, even here locally, solutions. Because in essence, what a money market does is that it pulls money from different investors. Then a fund manager, like Absa Asset Management, deploys that money in instruments which are very safe. So instruments like T-bills, bank deposits, and a few high-grade commercial papers, right? So you'll find from a volatility perspective, it's very, very balanced. There's not much volatility. The return expectation on that is it beats inflation to a large extent. So you'll find a range of between 7 to 9%. You look like at our Absa money market last year, it did about 9.5%. And with money markets, there isn't a lot more in terms of monitoring. It's very passive, and it's very prudent for three types of scenarios. One, whenever there's a bit of crisis that I'm not certain where to park this money, it's a good place to park money as you try to monitor the situation as it occurs. Secondly, it's good for goal-based savings. That means I need to travel next year, I need to pay school fees next year, I need to make a down payment on a car next year. It's ideal for that sort of planning. The other way is that it's a pit stop. You know the way in Formula One you have a pit stop? So it's a pit stop whereby, as I want to grow into the next asset class, where do I accumulate enough money to go into the next asset class? And that's where now the money market comes in. Very low risk. Tenor tends to be anything within 2 years time frame. If you have a 2-year time frame, that is where you would park money in a money market. The other aspect that Mwenda has also mentioned is around our bond space. So when we call it fixed income, the secret is in the name, fixed. So it implies I'm investing whereby I'm getting a very predictable, regular fixed return. And this is where now the bonds come into place. So bonds, in essence, are debt instruments. So I, as a corporate, like you saw recently, EABL and Safaricom issued bonds. I want to expand, I want to do a project. So I come to the public and say, I want to borrow money from you. You give me this money for this period of time under this market condition, under these return expectations. So that's what the bonds come in. And bonds can be either issued by corporates or as well as government bonds. So to focus mostly on the government bonds, because that's still a very popular investment vehicle, is that in essence you're lending money to the government of Kenya. So I'll take an example. So government of Kenya says, you give me your money for 5 years and I'll pay you a rate of 10%. So assumingly, if I give the government of Kenya 10 million, it means I'll be getting 10 million multiplied by 10%, that's $1 million bob a year. That's $1 million is divided into 2. So every 6 months, like clockwork, I get my $500,000, $500,000, $500,000. So again, the $500,000 is fixed and is predictable. So you can't actually plan for that money. And a lot of investors, what they try to do is also that, as opposed to just getting one bond, I can't curate a portfolio. Because the 6-month cycle generally works like January, July, February, August, March, September, April, October, May, November, June, December. So as opposed to putting my 10 million in one specific bond, I can come to an asset manager like Absa Asset Management and get a portfolio of different bonds that pay different times of the year. That way I have cash flow coming in every so often, because that is what is financial freedom, whereby you have created passive income, either enough to replace your active income or to a large extent support you. And this is very critical also for people who are about to focus on retirement, because at retirement level, the main ask is cash flow and healthcare. So how do I mitigate the fact that I'm no longer active, I'm no longer running a business, I'm no longer doing active employment? And if you look at our last webinar, there's a segment where Mwenda and Elizabeth took a journey map of somebody in their 20s, somebody in their 30s, and somebody in their 50s. And you'll find different asset classes, their allocation will differ based on where I am at in my life. So for the viewers, if you had a chance to look at our last webinar, please revisit it, and you'll have a very comprehensive lifestyle sort of investment. In terms of the next asset classes, we're looking at equities. So equities, in essence, you're buying ownership in a company with the expectation that, one, this company will perform very well, and two, I'll get a part of the profits that the company is delivering. So you buy a company like, say, Safaricom or Absa, most of them are listed on the Nairobi Stock Exchange. At 5 shillings, the price moves up to 10, that's what we call a capital gain, right? At the same time, as companies declare their profits, they say, we will distribute part of this profit to the clients, and that's what is called dividends. So when you invest in equities, you expect two sort of returns. One, either a capital gain in terms of the company performing well and the share price going up, or secondly, dividend in terms of them distributing their profits. So Mwenda has mentioned about how our stock market has performed last year. So Nairobi Stock Exchange was one of the most best performing in Africa. I did think they did in the north of 50%. So, and that has come through a lot of intentionality in that, one, there's a lot more information being cascaded to the public. Two, there's a lot more retail investors participating. And then three, there's some intervention that the NSE has done, sort of like breaking down that the minimum share you can buy is 1 now. Before it used to be 100, and that used to lock out a lot of people. Now you can do it at 1. But as a normal common investor, do you have the time and the headache to track which share do I buy, which share don't I buy? That's why now the equity funds come in. So equity funds, in essence, is a pool whereby the fund manager invests in shares. So you as the investor don't have the headache and the hassle of thinking, where do I buy? Do I buy this? Do I sell this? That is the work of the fund manager. And at Absa, we have an equity fund which performed significantly well. I think Mwenda was being modest when he said 40s. I think it was 48 plus. But that also gives you an exposure to the Nairobi Stock Exchange. And you can see the level of corporate earnings that have been declared, right? Through even from the financial sector. That's a good area of focusing. The other aspect is that from a currency perspective, and sorry, let me take you back to the bonds a bit. So on the bond space, Kenya issues 2 types of bonds. The government of Kenya issues 2 types of bonds. So we have the Kenya shilling bonds, which in essence, pay you on a regular basis, but you still have the euro bonds, right? I know the name might come with a bit of heat, but the name euro bond just implies it's a dollar-based bond, right? That has become very popular over the last couple of years, largely because there's a bit more currency diversification. A lot of people now are focusing more on how do I hedge myself, I think, the Kenya shilling, how do I start earning some hard currency in dollars? So Kenya has about nine of them, different ranges in terms of where they're maturing, but the minimum quantum size is $200,000, right? But for that quantum size, then again, that's where the fixed income funds come in, whereby you can have a fund manager who gives you indirect access to some of those solutions. To cross borders, offshore investment is another key consideration. So there you are having more exposure in terms of the global market, right? You have more exposure in terms of asset types, currency, whether you can do it in dollars and pounds. Because the thing with an investor is that you should never have one currency. You should always try to balance that money in different currencies, and especially the hard currencies tend to have a store of value. So that's why now the offshore investments come in. And at the moment, you'll find instruments like structured notes, which is some of the instruments that we offer. They give you a bit more hedge in terms of any volatility, whereby despite markets dropping, there's still a payment that comes through. So as a bank, we have basically partnered with investment banks offshore to run our offshore investments, right? and there you are instruments known as structured notes. So in essence, they are issued in dollars and pounds. Minimum quantum is $50,000 or pounds, and you're potentially earning double digits returns, right? And the hedge around that is that I don't have everything concentrated in Kenya. The same famous statement of diversify, diversify, diversify. So I'm diversifying, one, from a currency perspective, two, from a regional perspective, and lastly, also from an asset type perspective. So that in case of any market conditions, be it the good times or the bad times, my portfolio overall is in a balanced situation. But to wrap it up in terms of how do we position this, there's a whole conversation which we need to sit down with an investor just to identify what is their need, what is their goal, then we make a proposal. So it's not a matter of you have a full buffet that you select from. It's an actually very need-based sort of discussion. Yeah.
All right, and Eric, I'll be coming back to you with another question in relation to what you've just said. But I want to remember to remind those who are following this conversation online that you have an opportunity to be part of this conversation. All you have to do is go on the chat and send in your questions. The hashtag to use is a legacy of wealth. In case you're on X, a legacy of wealth is the hashtag that you can use. In case you're following this conversation on YouTube, just go in the comment section and post your questions there, and we will be making sure to fill those questions to the experts here. And now, Eric, allow me to come back to you with a question on, for Jimmy here, who's not a sophisticated investor, who's debating between the bonus that I've just received. I'm debating between going into corporate bonds or going into government paper. What are my options and why?
Okay. So Jimmy is the non-sophisticated or sophisticated. So one, I think the objective is always what matters, right? Because different investment options work differently. So when you ask from a bond perspective, or corporate bond or local bond, what your answer is, are you looking for income? Are you looking for steady income, steady passive income that is coming through? So at the moment, with rates sort of in a low interest rate regime, you'd have to find that a decent, consideration would be some of the high yielding bonds that are available in the market. Because we have access to the secondary market, whereby in essence, you are buying bonds which are already running, bonds which are paying a premium, bonds which can be customized. In that, if your time horizon is 5 years, there are portions for that. If your time horizon is 10 years, if your time horizon is 20 years, or even if you have a specific month that you do want a payment. Because there are people, let's say, who you pay, assuming Jimmy pays school fees every quarter, you can curate a portfolio that pays you on a quarterly basis, right? So from a bond space, options are many, different tenors, different sort of returns, but the key thing is that if you can achieve a sort of a portfolio which pays you more on a month-to-month basis, that would be the first consideration. But as you think about what to invest in, that's why now you should put money in the money market, because money tends to itch. When you have money in your pocket, you tend to utilize it. So pack it in a money market as you think and contemplate, how do I deploy it into different asset classes, as you also empower yourself from an informational perspective.
All right, and I saw Mwenda nodding his head. I think he has something to add on this. And Mwenda, even as you add on that, maybe you could also talk to us about this diversification. And when I'm thinking about a money market that I want to park my capital in for a period before I make that big move and decide where I want to invest in, what are some of the key elements of this money market fund that I need to be thinking of so that I also minimize my risk?
Thank you, Jimmy. And when you talk about corporate or treasury or government bonds, then the question is, as a lender, who are you more comfortable lending to? Is it a corporate or is it the government? Where do you think the risk is lower? Where do you think you have a lot more sight in terms of the level of risk? And what kind of return are you expecting to earn from either of them? Now, one of the things that we also need to wake up to is the fact that when you have a heightened risk environment globally, that of course also creates a lot of risk locally, which you have also seen. So you want to make sure that at any one time when you have high risk levels, then you don't want to take too much risk. You'd rather lend to the most stable entity, lend to a more stable pair. The same way, if you are lending to individuals in an environment where you know businesses are not doing too well, you have challenges here and there, then what would you rather do? You would want to lend to the person who you know has a lot more in terms of capitals, has a lot more in terms of capacity to pay. But then again, the person who has a lot less in terms of capital, you can charge them a higher price. So the question is, the corporates that are actually looking for this money, what kind of price are they paying vis-a-vis what the government is paying? So the stronger corporates, of course, would be almost quasi-government and will not give you a higher return. We have not, the ones that we have seen raising money in the recent past, the EABL, the Safaricom, when you look at what they offer in terms of return vis-a-vis where the government is at, the risk you're taking, you're probably not being compensated properly for it. So you'd rather sit with government in certain situations unless the corporate is compensating you for the extra risk that sits with the corporate vis-a-vis the government. Now, when we talk about windfalls, and one comedian once said, money has a way of talking to you if it's in your pocket. So you need to make sure it's sitting somewhere as you make decisions, because if you keep it in your bank account, you're swiping your ATM, end result is you probably will spend it. And money market funds are meant purposely to provide you an opportunity to think about this money as you make the decision. Before the decision is made, where do you park that money? And that's the reason why money market funds have a lot of liquidity. You can get your money within 72 hours. They have low minimums. They are a savings vehicle. They are not necessarily an investment vehicle, but more and more of a savings vehicle, where you put money, you accumulate money, and ensures that you're not risking any capital. Because as well, before you make a decision on this money, you want to make sure it remains as a lump sum. Because the moment you start chipping into it, whether by taking too much risk into an investment and you don't have a long-term view into it, during that short term, and Elizabeth did paint a very good picture of the short-term thinking and the long-term thinking, during that emotional period, you do not want to make any decisions during that emotional period. So where do you keep this money so that the emotions die down and you now can have a proper, rational, long-term view and look at all the options available, where else it's earning you something. Because if it stays in your bank account as well, if it sits under your mattress, it doesn't earn you anything. So the money market fund ensures that the money remains available when you need it, but it actually is earning you something, because if it is not earning anything, it's losing value at the rate of inflation. Yeah. So you want to make sure it sits somewhere and you park it.
All right, so Mwenda, just before you close on that point, so as a customer, what are some of the things that I need to look at before deciding that this money market fund is the one that I want to put my money in? What are those key critical elements that maybe as a customer who's new into this sort of savings I might miss?
Thank you. And Jimmy is asking me to do an analysis of the industry. Which is and
you can just give us the characteristics,
different money market funds have different levels of risk that they take. What determines risk, and I know we discussed a lot of this even in our previous webinar, what determines the level of risk that is sitting in any fund is the underlying assets. What has the investment manager actually bought for this fund? Where are they investing this money? So depending on where the money is invested, that determines the level of risk that you are taking as you invest into the fund. And that also determines the level of return that you expect, because returns come from the risk. But we need to be alive to the fact that this risk can also materialize. And therefore, if it does materialize, it comes with a loss. And that loss will impact your capital. So if you're going to a money market fund, you're looking for safety. You're looking to make sure that as I think about it, I'm not losing anything. I need my money safe. It's not a return discussion. It's more and more of a safety discussion to ensure that, one, inflation is not hurting you, and your capital is also not disappearing. So you want to, it's meant to be a low risk vehicle to provide that kind of a setting. So when you go and evaluate the underlyings, then you need to make sure that the underlying assets have the same kind of matrices. Deposits, capital is not lost. You have a return that is coming in. It's above inflation. A bond, on the other hand, is a very different vehicle. A bond has price movements. So when rates go up, you'll actually lose in terms of capital, and that impacts you. So if you're looking for safety in your capital, then you need to be very, very cognizant of the fact that whatever fund you're buying into, make sure the assets meet the objectives that you have. If your objective is safety, your objective is to park money there as you make a decision, make sure your capital is safe, then you want to make sure the assets as well are assets that provide that. So lift the veil, look at the underlying, and make sure they do meet your objectives as well before you put your money into a fund. All
right, now I want to bring Liz back into this conversation, and I could see her agreeing with a lot of the comments that have been coming in. Now, Liz, in your presentation, one of the things that you talked about is some of this, the risks that we are currently facing, the volatility. We're talking about wars, we're talking about trade tensions, we're talking about supply chain disruption. But the question that I want you to help us understand is, how do we position ourselves amid all these risks? Because with every crisis, there's also an opportunity somewhere in there.
Okay. Now, that's a good question. So the crisis brings uncertainties and things like that, and disruption. So one of the things and fundamentals of stability in your financial journey is to ensure that first, you have created a buffer to protect yourself should things pan out really ugly, because they can pan out ugly. And one of the ugly things that the world is trying to prevent, and we've had it being spoken even at the UN, is inflation. That inflation will go up. It means that your purchasing power of your shilling or your dollar is going to be disrupted. So you need to have kept aside enough emergency fund. And the rule is very simple. If you're single with no dependencies and that kind of thing, ensure that you have your 3 months of emergency, and that should be sitting in a liquid form, because if you don't have it in a liquid asset class, it could mean that when you want the money, you will not be able to get the money out. So your money market funds, your bank deposit, savings account, not CASA, your savings accounts make sense for that type of emergency fund. Then the other one is for people with dependents. Those of us who are parents, our costs and our expenses per month are actually huge, and therefore, for that reason, it is recommended that you should have at least 6 months of your emergency fund. If you've not started, it is okay to start even now, because the realization has come. So don't guilt trip yourself. Just start it off and start building that and keep it safe. Other than that, you're all on a journey of building wealth. During crisis, we go through cycles and we go through what we call volatilities that present opportunities to get into markets or into growth assets. As it was explained, the growth assets will give you long-term growth, but you need to have the resilience to stay through the season of volatility. What do you buy for that growth? You buy equities, a breadth of equities, and what happens here is you need to have a professional manager helping you to choose the right portfolio, to curate your portfolio such that it is a resilient portfolio that is anchored for future growth. That is what we do in an equity fund. If you're starting today, and if you want to go directly to the exchange, you definitely have to do a lot more research, empower yourself with information and knowledge, and build a portfolio that is resilient. That doesn't mean you don't get into your properties and all that. Evaluate your portfolio in totality and see what percentage is sitting in a certain asset class and the next asset class. If you need to replace your income, you need to buy your fixed income fund and your bonds to make sure that you diversify. Now you're affluent. When you're affluent is a different conversation, and that is what we were seeing my colleague Eric talking about. We need a personalized portfolio discussion so that we can help you see the full picture and start reallocating and rebalancing your portfolio to fit you, because now we are not talking about somebody who is dealing with liquidity or near needs like expenses. But most Kenyans, we are at that point where we need to safeguard survival. So survival will be safeguarded by making sure that you're investing with a mindset of ensuring that you can live next 3 months, next 6 months comfortably, and at the same time a part of your portion is growing. Yeah, so that's the kind of engagement you need to have. It's very intimate and it's very close, and we are available for that kind of conversation to help everybody build resilience around their wealth and growth around their wealth. And finally, and maybe something that is not in the capital markets, is really to speak to the younger generation. You must also invest in yourself. It's a very important thing that we consider ourselves as a first investment, because we have to make the first savings that we will use for building the portfolios. So investing in yourself means that you are getting the skills for the future, skills that will take you to the next level, and therefore making sure that your income generation capability is rising and you're not being disrupted, because the world is getting disrupted even at a skills level. So very important that you look into that, especially if you're a young person, but that doesn't eliminate the rest of us, because we must be ready for a future that is really looking different even as we speak here. Yeah.
All right, so Elizabeth, before we get into the questions, and I can see a number of questions that are coming in and a lot of interest that is being generated out of this conversation, I want you to help us understand, for someone who is earning here in Kenya, and I'm looking at getting into the global market, based on the volatility that is currently there, should I work on reserving this capital? Should I invest in something locally? How do I then weigh what decision to make, particularly on whether to get into the global market or to reserve that capital for now?
Okay, good question. And I still continue to be very conservative in saying it's a one-size-fits-all, because it isn't. Investment is not a one-size-fits-all. But if you're going to the global market and you want to extend your investments beyond Kenya, look at an index that is giving you exposure to large sectors and industries across the world, because then you will be anchored to ride out the volatilities that come, rather than, say, for example, chasing oil at the peak. You know, like you say, I'm going to buy oil because now I know I've had people talking about $200 per barrel. So oil sort of seems like it's an in thing, or gold may go to 10,000. That's speculative. So I'd really discourage anybody from going to a speculative portfolio. Rather, in a world that is disrupted, I would stay more diversified and gain across the spectrum than gain or try to chase or time the market, because one way of making wrong decisions is chasing stocks at the peak. In this period, the stocks that look like they are going to be really outperforming is, say, oil, because there's a whole conversation of $200 that is coming. So you could think, let me buy, but you'll be buying at the peak.
It's very enticing for sure.
It is.
Yeah.
So you could go at the peak. So you really need to avoid falling for such baits. Or gold, you just buy gold. But yet you need the anchoring. So you need to think through strategically without eliminating that there is opportunity, but you cannot bank everything on one side. So diversification is the way to go.
All right, thank you very much. Of course, diversification is the way to go. Now, we want to get into a number of questions, and some of them that have come in. We have one from Rachel Otete, who's asking what aspects to consider when evaluating one's risk profile. I think, Eric, you can take that. And also in relation to that, we have, I think this is Cool Karaoke, who's asking, what about risk factors of Eurobonds?
Okay. So let's start with the fact that also, before I even answer that question, I want to add to what Elizabeth said about it's always not about timing the market, it's about timing the market, right? Because more often than not, if you are timing the market, you're already too late, because the hype has already occurred, people have already invested in, so you're coming in high. So just to distinguish, are you an investor or are you a speculator? So investor long term, speculator, you're always trying to time. So from a risk perspective, some of the things you need to look at, I think knowledge is one of them. Are you knowledgeable in what you're investing in? Or do you have a bit of acumen in terms of financial standpoint? Because knowledge allows you to see that if I look at this solution that is in front of me, do I have a bit of understanding around it? So knowledge is one factor when you're looking at your risk profile. Secondly, is also past experiences, because people read a lot. So you'll find, oh, my friend got burnt in this investment vehicle. So you anchor your information based on your friend's experience. So you also have to identify, are there past experiences which are giving me biases? Thirdly is liquidity. Liquidity means, what is my cash flow? Am I liquid? Am I not too liquid? At the stage of life I'm in, am I willing to park money for so long, or am I in a phase of actually accumulating and growing? The other thing is also, from a point of one, knowledge, secondly, past experiences, thirdly, liquidity. So the other thing is also about what is my emotional, what do you call it, personality? Am I somebody who's very emotional, or am I somebody who's very tapered, a thinker? So there's a bit of risk profiling that goes around, which asks a lot of those questions. Because one, we say human beings make decisions factually, but more often than not, it's emotional. Most people tend to make the decision emotionally. So you have to also to look at, from an emotional perspective, how am I generally as a person, right? How am I generally as in a normal situation? How do I handle things? So try to balance the emotional bit and also the factual bit when you're doing your risk assessment. Second question was the Eurobond, right?
Yes. We have Cool Kaki who's asking, what about the risk factors of the Eurobonds? And also a similar question from Rajendra Tewari who's asking, what is expected return in Eurobonds?
Okay, so let me start with the second one first. So the expected return on Eurobonds, so Kenya has 9 of them. Like I said, as of now, we have 9 of them, different returns, different range. But from a tenor perspective, you're looking as short as 2027 and as long as 2048. In between, there are 7 others which mature at different times. From a rate perspective, you're looking at 7% on the lower end of the curve, all the way to 9.75% on the higher end of the curve. But then again, there are many of them within that spectrum. It's always a matter of what is my time horizon, which one do I fit within my scope. So in terms of the Eurobond, I think the concern that came in was largely in 2024, because there wasn't a lot of concerted effort in terms of concern, will Kenya pay that debt, which was due in 2024. So that's when the whole Eurobond concern has started to come into the market. But you look at the steps which have been taken from then up to date. One, there's a bit more structured liability management from a government perspective in terms of, one, lengthening the maturities on some of these securities. Secondly, there's a lot more money coming back into the emerging markets. Because remember, just before 2024, there was a lot more money moving from emerging markets to the developed markets because the rates there were a bit higher. Now the reverse is what has occurred, whereby you have more money coming back into emerging markets. So that brings a bit more stability in terms of our debt securities are a bit more attractive from a point of investors' perspective. Thirdly is that you look at the last 3 or 4 issuances, we have been oversubscribed. So that is a vote of confidence. So when I issue a debt and I get more people wanting it than what I wanted, that gives a vote of confidence from that perspective. So 3 things have occurred. 1, there's a bit structured liability management. Secondly, there's a bit more cash flowing back into emerging markets. And 3, the vote of confidence from a lot of investors have come into place. But that being said, there's always a risk in any investment. I think the concern is that, can I accommodate this risk? And what is the probability of this risk occurring? Because anything is possible. The element of probability is what you look at. And as Mwenda said, government debts is one of the lowest risk from a payment perspective, because the odds of a government defaulting are very minimal, if any. Yeah.
All right, and I want to bring Mwenda into this conversation. A number of questions that are also coming in that I think, Mwenda, you can take this. We have Florence Muthe who's asking, can you anticipate similar performance of the equity fund in 2026, factoring in pre-election period? Okay. And also a similar question to that from Ruben Gishana who's asking, what was Absa's equity fund performance for last year in percentage?
Okay. So last year, I'll start with the second question, and thank you very much for the questions. So on the equity fund last year, our performance was 40% in terms of return, which is of course significant. It's not just a double digit, it's actually a high double digit. As whether that can be replicated in 2026, a couple of things need to be looked at. One, economically, are we still stable? Do we still have strength? Are there risks that have shown up? We have discussed the risks. There are definitely risks that we are seeing from an economic point of view. But then again, corporates will take time before, the economic side will take time before it takes impact as well, and whether we're able to have an insulation against that, and we did discuss some of those items that have to do with inflation. So what are we seeing in 2026? One of the main drivers of any corporate's earnings is consumption. Are people spending? And we did discuss about your share wallet. How much are you spending in terms of your airtime? How much are you spending in terms of what you're buying? And then so we have had challenges in terms of consumption, and that of course has been a challenge, and there's no question about it. But 2024, 2025, we have started seeing the recovery of the same. A big way of bringing money back into people's pockets is debt. And it will be good for us to also speak about debt management, even as you receive your windfall. What do you do with it? Do you pay back debt and the likes of such discussions? But then debt is actually a very good thing to a large extent. It enables you to be able to consume, and as you consume, then the corporate, of course, has a growth in revenue because you're buying from the corporate. So it all begins from the normal mwananchi. If this mwananchi has inflation issues, if this mwananchi has their income being eaten away by taxes, then the corporate will feel that pain. But if we have a bit of reprieve on the same, and they now are able to borrow at a cheaper rate and consume, then the corporate will also feel the same. The same corporate is also able to build, to buy cheaper and reinvest this money and to do a bit of R&D, invest further. And we have started seeing banks, of course, lending. And we do expect that lending to keep spurring consumption in 2026. That means, fundamentally, the institutions are still expected to perform well in 2026. Whether that transmits to the price is dependent. That's why we did talk about the fact that the market has changed significantly. We do not see a lot of foreign participation, which means we don't see a lot of capital flight as well. What retailers do, and what, I know you spoke about speculators, but speculators are good because what speculators do is they provide price discovery. You actually have transactions going on at all times, which means the fundamentals can be seen on the price. So if you do expect fundamentals to still remain strong, we still expect banks to perform well, we still expect Safaricom to perform well, we still expect EABL to perform well, then end result is, will we have a transmission? As long as we have proper participation of retailers, we have the same kind of market activity we have been seeing, then that will be transmission in the price. It may not be at the same level because remember, these fundamentals have been transmitted in terms of price for the last 2 years. And you have seen 100% growth in the last 2 years. We may not see the same 40% level, but we will definitely see positive growth that should deliver quite a bit of return for you, even in 2026.
All right, thank you very much, Mwenda. And just some feedback on the conversation that we are having. And we have an interesting one here from David K, who says Absa needs to set an investment learning academy for its clients. Unfortunately, this information is not taught in school. And yes, David, that is exactly why we are having this conversation. So you're tuned in to the right platform. And this conversation is not just happening today. It's an engagement that will keep going on over different topics, just helping you to manage your inflows and ensuring that even as you're looking at making that investment, you are well informed, that you're well educated on some of these things. Now, Liz, I want to bring you into these questions. I want you to take a question here where we have someone who's asking, this is Isaac Karanja, who says, I want to learn where I can invest. If I have like 1 million or 2 million, where can I invest? And also track my monthly returns or profit in this case.
All right. So David wants to invest 1 million shillings. Well done. I think that's where we
Isaac
start.
actually, Isaac Karanja. Yeah.
Yes, Isaac, well done. That you have already postponed consumption and you want to grow that wealth. So to start you off, I think I would say if you are a starter, and maybe we call them like newbies in the investment. If you're a newbie, please start with an investment that rewards you positive, because your investment experience will determine how you will relate with other investments in future. And investment pain or heartbreaks last a lifetime. That one you have to keep in mind. So if you're starting, ensure that you start with an investment that gives you a positive return, and you can see the return and you can feel it, and therefore you have emotional boost that indeed my money is working for me. What do I mean? If you take the 1 million and we take it to his equity fund, which is doing 40s, what he hasn't said is that equities go up and down. So equities can go down, and it could be that year that equities maybe make -10. Yeah. And you put your 1 million, and at the end of the year, you come and you ask Elizabeth, so I put 1 million, what do I have? And I tell you, oh, at this point, we can see your portfolio at 900,000. It will break your heart, and you may think, this is what happens all the time, every time, and therefore it will rupture your ability to continue with this journey. So we tell beginners, let's start at money market, let us learn. Let me give you that return of 7.5% or 8%. Every month it's a positive, your capital is growing. And if you're a bit courageous, maybe you're young, I will tell you, David, you're young, and therefore I'll put 50% in money market so that I protect your fragile heart, and I'll take another 50% perhaps in a portfolio that is mixed between bonds and equities, and gives you a kicker in returns and in growth. Then as you mature, I'll transition you softly to other asset classes such that in the event in one period we suffer a negative, you actually have the resilience to know that it's a bump, we ride it, we move to the next one. So that's how I would look at it, but again, very personal. Let's talk about it when we have better details about your profile.
All right, thank you very much, Elizabeth. Now, there's a lot of interest that is coming from our audience, particularly on the Absa Money Market Fund. And Eric, there's another question here who says, for Absa MMF, this is Zipporah Muideri who asks, for Absa MMF, is there capital preservation? And also in relation to that, there's Keval Shah who asks, who do I speak to about this? Do you have investment advisors, or do I speak to my relationship manager?
Okay, so to give us the second question, so any branch, if you walk to any Absa branch, which we have over 84 in the country, you will get this information. They'll be able to link the client with our team from head office, or even some of the staff members in the front line have an understanding about our investment. They will be able to engage. I think at the end of this webinar also, we'll share our contacts from the Absa Asset Management team, so whereby again you can be directly assisted. If the client also has a relationship manager, we have a team of over 35 relationship managers, well certified in the investment space. They can have that discussion with the client. So there are various channels to which to access us, right? The first question was on the money market. Come again, please repeat.
All right, let me just find it. I think there was a question on capital reserves.
Capital preservation.
Yes.
So I think when Wenda was talking about what is under the hood, when you lift the veil out of these investments, what is there fundamentally? So you look at what our money markets invest in. Treasury bills, short-term deposits, and high-grade commercial paper. That, to a large extent, capital preservation is key, right? So to answer the question straight on, yes, capital preservation is the main focus, safety and liquidity. So you look at the underlying assets, the capital preservation element is very key.
All right, thank you very much, Eric. I'm just reading through Josephat Mumbura's question, and I think any one of you can take this, where he asks Absa structured notes. Number one, he asks, what is the average return on this? And the second question he asks is, what is the available leverage option on this investment, at what average cost? And three, what is the average commission / cost?
Take it. Yeah.
Okay, so let's start